Bill Black. The former director of the Institute for Fraud Prevention now teaches economics and law at the University of Missouri, Kansas City. During the savings and loan crisis, it was Black who accused then House Speaker Jim Wright and 5 U.S. senators, including John Glenn and John McCain, of doing favors for the S&Ls in exchange for contributions and other perks. The senators got off with a slap on the wrist, but so enraged was one of those bankers, Charles Keating, after whom the Senate's so-called Keating Five were named, he sent a memo that read in part, "Get Black, kill him dead." Metaphorically, of course. Of course. Now he's focused on an even greater scandal, and he spares no one, not even the president he worked hard to elect, Barack Obama. But his main target are the Wall Street barons who are heirs of an earlier generation whose scandalous rip-offs of wealth back in the 1930s earned them comparison to Al Capone and the mob, and the nickname banksters. Bill Black, welcome to the Journal.
Thank you.
I was taken with your candor at the conference here in New York to hear you say that this crisis we're going through, this economic and financial meltdown, is driven by fraud. What's your definition of fraud?
Fraud is deceit. And the essence of fraud is I create trust in you, and then I betray that trust and get you to give me something of value. And as a result, there's no more effective acid against trust than fraud, especially fraud by top elites. And that's what we have.
In your book, you make it clear that calculated dishonesty by people in charge is at the heart of most large corporate failures and scandals, including, of course, the S&L. But is that true? Is that what you're saying here, that it was in the boardrooms and the CEO offices where this fraud began?
Absolutely.
How did they do it? What do you mean?
Well, the way that you do it is to make really bad loans because they pay better. Then you grow extremely rapidly. In other words, you're a Ponzi-like scheme. And the third thing you do is we call it leverage. That just means borrowing a lot of money. And the combination creates a situation where you have guaranteed record profits in the early years. That makes you rich through the bonuses that modern executive compensation has produced. It also makes it inevitable that there's going to be a disaster down the road.
So you're suggesting or saying that CEOs of some of these banks and mortgage firms, in order to increase their own personal income, deliberately set out to make bad loans?
Yes.
How do they get away with it? I mean, what about their own checks and balances in the company? Or what about their accounting divisions?
All of those checks and balances report to the CEO. So if the CEO goes bad, all of the checks and balances are easily overcome. And the art form is not simply to defeat those internal controls, but to suborn them, to turn them into your greatest allies. And the bonus programs are exactly how you do that.
If I wanted to go looking for the parties to this with a good bird dog, where would you send me?
Well, that's exactly what hasn't happened. We haven't looked, right? The Bush administration essentially got rid of regulation. So if nobody was looking, you were able to do this with impunity, and that's exactly what happened. Where would you look? You'd look at the specialty lenders, the lenders that did almost all of their work in the subprime and what's called Alt-A, liar's loans.
Liar's loans. Why did they call them liar's loans?
Because they were liar's loans.
And they knew it?
They knew it. They knew that they were frauds. Liar's loans mean that we don't check. You tell us what your income is, you tell us what your job is, you tell us what your assets are, and we agree to believe you. We won't check on any of those things. And by the way, you get a better deal if you inflate your income and your job history and your assets.
You think they really said that to borrowers?
We know that they said that to borrowers. In fact, they were also called in the trade ninja loans.
Ninja?
Yeah, because no income verification, no job verification, no asset verification.
You're talking about significant American companies.
Huge. One company produced as many losses as the entire savings and loan debacle.
Which company?
IndyMac, specialized in making liar's loans. In 2006 alone, it sold $80 billion of liar's loans to other companies. $80 billion.
And was this happening exclusively in this subprime mortgage business?
No, and that's a big part of the story as well. Even prime loans began to have non-verification. Even Ronald Reagan, said trust but verify.
Right.
They just gutted the verification process. We know that will produce enormous fraud under economic theory, criminology theory, and 2,000 years of life experience.
Is it possible that these complex instruments were deliberately created so swindlers could exploit them?
Oh, absolutely. This stuff, the exotic stuff that you're talking about, was created out of things like liar's loans that were known to be extraordinarily bad. And now it was getting AAA ratings. Now, a AAA rating is supposed to mean there is zero credit risk. So you take something that not only has significant, it has crushing risk. That's why it's toxic. And you create this fiction that it has zero risk. That itself, of course, is a fraudulent exercise. And again, there was nobody looking during the Bush years. So finally, only a year ago, we started to have a congressional investigation of some of these rating agencies. And it's scandalous what came out. What we know now is that the rating agencies never looked at a single loan file. When they finally did look, after the markets had completely collapsed, they found, and I'm quoting Fitch, the smallest of the rating agencies, the results were disconcerting in that there was the appearance of fraud in nearly every file we examined.
So if your assumption is correct, your evidence is sound, the bank, the lending company created a fraud, and the ratings agency that is supposed to test the value of these assets knowingly entered into the fraud. Both parties are committing fraud by intention.
Right, and the investment banker, that we call it pooling, puts together these bad mortgages, the liar's loans, and creates the toxic waste of these derivatives. All of them do that. And then they sell it to the world, and the world just thinks that because it has a AAA rating, it must actually be safe. Well, instead, there are 60 and 80% losses on these things because, of course, in reality, they are toxic waste.
You're describing what Bernie Madoff did to a limited number of people, but you're saying it's systemic, a systemic Ponzi scheme.
Oh, Bernie was a piker. He doesn't even get into the front ranks of a Ponzi scheme.
But you're saying our system became a Ponzi scheme.
Our system
Our financial
became
system.
A Ponzi scheme. Everybody was buying a pig in the poke, but they were buying a pig in a poke with a pretty pink ribbon, and the pink ribbon said AAA.
Is there a law against liar's loan?
Not directly, but there are, of course, many laws against fraud, and liar's loans are fraudulent.
Because?
Because they're not going to be repaid and because they have false representations. They involve deceit, which is the essence of fraud.
A few years ago, she considered herself virtually homeless, spending nights with family and friends.
I would go to the place where I had my stuff stored, literally pack it in a suitcase, and then for that whole week lived out of the suitcase as I went back and forth.
Then she saw a condo in this house near Boston. The price? Over $250,000. She says that as a personal trainer, she was making less than $20,000 a year, $1,600 a month.
I really wasn't educated in what it takes to get a mortgage. I knew that you give them your information and they run the numbers and they tell you whether or not you can afford it.
There's a formula, I either fit in it or I don't.
Correct.
The mortgage company determined Paula did fit in and gave her 2 loans to cover the full amount of the condo, $259,900. Her monthly payment on those loans, more than $2,100, even though she was taking in only $1,600 a month. Paula planned on making up the difference by having her sister move in and splitting the cost.
I was assured after a year you can refinance. And so in my mind, if I pay this for a year, then I can refinance and get into a better loan.
Loans like the one Paula got were being handed out by the millions, and even she now wonders why.
Why would they tell me, as the lender, that I can afford this if they know they're not going to get their money back.
Some consumer finance experts, like Elizabeth Warren of Harvard Law School, think there was method to the madness, which she compares to salesmen hawking products they know are defective.
This is about buying toasters that at the moment they were sold, the person selling them knew these things are going to explode.
But why would a lender issue a loan that a borrower might never pay back? Some blame the problem on a good idea gone bad. Beginning in the 1990s, Congress made it easier to get a mortgage.
70% of Americans who own their own homes today, in no small measure, do because of the work that's been done here.
The rules for lending were eased so more people could qualify for mortgages. And with millions more now qualified, the lending business boomed.
I'm with Countrywide, and I got them all approved.
The biggest player of all, Countrywide Financial, run by CEO Angelo Mazzillo. It was Countrywide that loaned Paula Taylor nearly $260,000 to buy a condo, even though she was clearly unqualified. So what was the incentive? Well, first, salesmen were paid commissions for every loan they wrote, and the lending companies collected fees. But there was a much bigger incentive to make as many loans as possible. A pot of gold overflowing with riches, a scheme powered by some of the biggest financial institutions on Wall Street. But it was all destined to fail.
It blew up because it was based on a scam.
Few people know more about the financial crisis than Harvard Law professor Elizabeth Warren.
Down at its heart, it was based on selling mortgages to people who simply weren't going to be able to pay them off.
It was all based on a series of lies, beginning with the loan application. On Paula Taylor's application, it said she earned around $90,000 a year, $7,300 a month, even though she says she told them she took home only $1,600 a month. She says she never noticed that inflated income until we pointed it out to her.
And now we'll hear from Mr. William K. Black, Associate Professor of Economics and Law, the University of Missouri, Kansas City School of Law. Mr. Black.
Committee, thank you. You asked earlier for a stern regulator. You have one now in front of you. And we need to be blunt. And you haven't heard much bluntness in hours of testimony. We stopped a non-prime crisis before it became a crisis in 1991 by supervisory actions. We did it so effectively that people have forgotten it even existed, even though it caused several $100 million in losses, but none to the taxpayers. We did it by preemptive litigation and by supervision. We broke a raging epidemic of accounting control fraud without new legislation in the period 1984 through 1986. Legislation would have been helpful. We sought legislation, but we didn't get it. And we were able to stop that because we didn't simply continue business as usual. Lehman's failure is a story in large part of fraud. And it is fraud that begins at the absolute latest in 2001. And that is with their subprime and their liar's loan operation. Lehman was the leading purveyor of liar's loans in the world for most of this decade. Studies on liar's loans show incidence of fraud of 90%. Lehman sold this to the world with reps and warranties that there were no such frauds. If you want to know why we have a global crisis, in large part, it is before you, but it hasn't been discussed today, amazingly. Financial institution leaders are not engaged in risk when they engage in liar's loans. Liar's loans will cause a failure. They lose money. The only way to make money is to deceive others by selling bad paper, and that will eventually lead to liability and failure as well. When people cheat, you cannot, as a regulator, continue business as usual. They go into a different category, and you must act completely differently as a regulator. When we've gotten and said sad excuses, the SEC, we're told there are only 24 people in their comprehensive program. Who decided how many people there would be in their comprehensive program? Who decided the staffing? The SEC did. To say that we only had 24 people is not to create an excuse, it's to give an admission of criminal negligence, except it's not criminal because you're a federal employee. In the context of the FDIC, Secretary Geithner testified today that this event pushed the financial system to the brink of collapse. But Chairman Bernanke testified we sent 2 people to be on site at Lehman. We sent 50 credit people to the largest savings and loan in America. It had $30 billion in assets. We had a whole lot less staff than the Fed does. We forced out the CEO. We replaced the CEO, and we did that not through regulation, but because of our leverage as creditors. Now, I ask you, who had more leverage as creditors in 2008? The Fed compared to the Federal Home Loan Bank of San Francisco 19 years earlier? Incomprehensible greater leverage in the Fed, and it simply was not used. And we've heard so let's start with the repos. We have known since Enron in 2001 that this is a common scam in which every major bank that was approached by Enron agreed to help them deceive creditors and investors by doing these kind of transactions. And so what happened? There was a proposal in 2004 to stop it. And the regulatory heads, it was an interagency effort, killed it. They came out with something pathetic in 2006 and stalled its implementation to 2007, but it's meaningless. We have known for a decade that these are frauds. We have known for a decade how to stop them. All of the major regulatory agencies were complicit in that statement in destroying it. We have a self-fulfilling policy of regulatory failure because of the leadership in this era. We have the Fed, the Federal Reserve Bank of New York, finding that this is three-card Monte. Well, what would you do as a regulator if you knew that one of the largest enterprises in the world, when the nation is on the brink of collapse, economic collapse, is engaged in fraud, three-card Monte? Would you continue business as usual? That's what was done. Oh, they met a lot. They say that we only had a nuclear stick. Sounds pretty good stick to use if you're on the brink of collapse of the system. But that's not what the Fed has to do. The Fed is a central bank. Central banks for centuries have gotten rid of the heads of financial institutions. The Bank of England does it with a luncheon. The board of directors are invited. They don't say no. They are sat down. The head of the Bank of England says, "We have lost confidence in the CEO of your enterprise. We believe that Mr. Jones would be an effective replacement." And by 4 o'clock that day, Mr. Jones is running the place. And he has a mandate to clean up all the problems. Instead, every day that Lehman remained under its leadership, the exposure of the American people to loss grew by hundreds of millions of dollars on average. Aurora was pumping out up to $3 billion a month in liar's loans. Losses on those are running roughly 50% to 85 cents on the dollar. It is critical not to do business as usual, to change. We've also heard from Secretary Geithner and Chairman Bernanke, we couldn't deal with these lenders because we had no authority over them. The Fed had unique authority since 1994 under HOEPA to regulate all mortgage lenders. It finally used it in 2008. They could have stopped Aurora. They could have stopped the subprime unit of Lehman that was really a liar's loan place as well as time went by. Thank you very much.
Thank you very much, Mr. Black. And now our last witness. I probably should reiterate that we ask our witnesses to confine themselves to 5 minutes. Summarize your testimony.